Welcome back in YouTube. Today we're going to talk about a special company. You know when I'm rocking the Mickey shirt? We're going to be talking about Disney. Now, as most of you know, I absolutely love the company. My wife loves the company, and she's actually invested in the company when I have advised not to. Today we're going to break down Disney, separate our feelings from the company and how we feel about the nostalgia of the company, what they offer as far as experiences, and relate it to a business investment, which are two separate things. Now, Disney overall is phenomenal for the economy, but is it a great stock to invest in? Disney creates a tremendous amount of jobs, boosts real estate, and causes travel to go absolutely bananas for this mouse experience. So the fact it has such an impact on the economy in a positive manner, does the business itself run efficiently? And can we invest in that business? And so we have to separate these two different things because I had my wedding at Disney and it was phenomenal. I love going to the parks. I love drinking around the world. I love riding the roller coasters. And we go to Disney Springs at least once a week. So am I investing in this company? Let's get into it. Now, Disney is trading at a multi-year low for the most part. The 52-week range on the stock is $126 down to roughly $84 and is basically trading towards the pandemic low when everything was shut off. And this big bump in the stock was them getting into the streaming business at the right time. And as we can see, the emotional move in stocks is completely different to what actually happens. And this reminds me of the AI boom. We've had AI stocks absolutely explode. And I tend to think we're going to see them separate the quality from the quantity, much like the streaming business. And just to give you an idea, the peak of that streaming business was pushing over $190 a share for Disney, making it absolutely expensive. Very similar, once again, to the AI boom that I think we're seeing today, that I do think will be corrected at some point in time. Now, personally running my calculations in what I believe the company is capable of doing, I recently have had a $75 price target on Disney, which was actually laughed at by a lot of people that saw this video, and now is looking very realistic. And this is why it's extremely important to stick to your valuations, ignore the noise, and only swing when you get a great pitch. There's tens of thousands of stocks out on the stock market. You don't have to swing every day. You can sit back and pick great stocks at great prices and be patient. And that's what individual stock picking is all about. And we work on this on the live stream. So if you guys would like a copy of this calculator, the only thing I ask is that you consider donating to the channel with a PayPal link down below and join us on our live streams. Now, if you guys were on the live stream of Disney, there was a few things I took away from the call and earnings. Number one, I thought the earnings were pretty bad overall. But the stock went up during the earnings call when Bob Iger stated that they're going to be adding more parks, more cruises, and cracking down on sharing passwords for streaming. Now, where Disney is actually making their money is on the parks and experiences. So the cruises and parks are going to be capital expenditures. So they're going to have to spend a tremendous amount of money to build out these parks. The cracking down on the streaming could add some extra value to the company. But these things are going to take multiple years to actually come to fruition and, in my opinion, impact the actual stock price of Disney. So a few things I want to share on Disney's quarterly report that are raising red flags. While the news that Bob Iger spoke is very positive for the stock over the next 5+ years, in my opinion, I tend to think that there's still going to be a lot of speed bumps from year 1 to 5. And the reason being is we've had a consumer that's been very strong and has supported this business with raising prices, going to the parks, and doing a tremendous amount of traveling. I can't predict that out in the future, which makes Disney a very sensitive stock to the consumer spending habits. And that makes me concerned because I tend to think consumer spending habits are at a peak right now, but I could be completely wrong. This is me just talking over the stock with you guys. Always do your own due diligence. This is not financial advice. But a few things I want to uncover in Disney stock. Number one, revenue is definitely growing with Disney. As we look at the 9 months ending from 2023 versus 2022, we can see that $62.5 billion in revenue versus $67.6 billion in revenue. Very good top line revenue growth. But the thing I want to point out is take a look at the cost here. 60.7 billion in cost versus 56.3 billion in cost from the year prior. But costs are also growing at a substantial rate as well. And this is the problem with Disney's business model. Capital expenditures are always going to be a sweat as a Disney shareholder. They have to maintain rides. There's a tremendous amount of staffing that takes place. And to grow these parks is very, very expensive. Every time they add a park, they have to buy land, engineers, staffing, and all this is very intensive capital expenditures. And this is why I don't think you need to rush to the stock, because as Bob Iger stated, they're going to be expanding these parks, and I tend to think the consumer's slowing down. They're going to be expanding these parks. These are going to be multiple headwinds in the short term for the company that I tend to think could actually bring the stock price closer to my buy price. Now, when we bring it down to a net income, and this is why I was surprised the stock actually went up, the company lost $460 million in the quarter versus $1.4 billion in the same quarter last year. And when we bring that down to a per share basis, they basically lost you, an investor, 25 cents a share, when last year in the same quarter, they were making you 77 cents a share. Now, personally, I would be expecting a little over $1 a quarter per earnings on Disney. And that's where I think the sweet spot for the company should be. And so now you guys are seeing why I was surprised that the stock actually went up with this news, because as an investor, I'm starting to look at this differently from the parks and experiences as a consumer versus investing in the stock as a long-term investor. I'm seeing problems ahead. They really need to fix streaming. They lost subscribers there. Yes, they're getting closer to making it more efficient, but we also want to see those subscriber growth. And that was a big problem in this company. The other things are, while the consumer is remaining strong, they're building into that. And I tend to think that this is good long-term, but in the next 1 to 5 years, it's going to cost a lot of money to do this. And the consumer could be slowing down here very, very soon. And so this is the thesis I'm personally building. So as I stated before, I'm going to keep my range between $65 to $75 on Disney. And I know, guys, that this still seems outrageous, but I want to reiterate that when this stock was over $120 a share, I had a $75 price target. And where are we today? We are actually not that far off to where I think I would be taking a risk on Disney, bearing that no major catalyst or any sort of downswing comes in the very near future. So if everything still remains the same, then I tend to think this becomes an interesting company with a 7 in front of it. We also have to remember that there is some political tension with this company. Business itself is dealing with some issues. And so I just don't think you need to run to this. And this is where the investing side becomes interesting. Are there better places to put your capital today? I think the answer is yes, but you have to decide that for yourself. As always, appreciate your time. Thank you so much for spending it with me, and we will see you in the next one. Peace.